Hi there. Thanks for stopping by the Equity Trust Virtual Classroom. My name is John Bowens, and in this short segment, we're going to talk about the proposed changes that are being made to long-term capital gains tax rates under the American Families Plan. We'll talk about how this can impact investors, how this can impact their returns, as well as how individuals are hedging against future taxation by utilizing a self-directed IRA, Roth IRA, solo 401k, or other tax-advantaged investment account. So first things first, what are these proposed changes to the current tax policy? Well, we need to first start off by what's the current policy as of the recording of this video. Well, the current capital gains tax policy works like this. If you buy an asset and sell it in under 12 months, you're subject to short-term capital gains tax rate, which is one's ordinary income tax rate. So for some individuals, high income earners, that's upwards of 37%. You then have long-term capital gains, which is if you buy an asset like real estate or stock or other private asset, and you buy it and sell it in greater than 12 months, then you're subject to long-term capital gains tax. Now, long-term capital gains tax rate for some individuals, lower income, is 0%. For if you call middle America, it's 15%. And then for individuals making over about 400,000, it goes up to 20%. So in other words, the highest capital gains tax rate currently in the United States is 20%. The proposed legislation will move that 20% to 39.6% for individuals showing income of $1 million or more. So what does that actually mean? Well, let's put it in the context of a real world example. So let's talk about investing in private securities. So here at Equity Trust Company, our clients invest in alternative assets, real estate, private stock, private startup businesses, cryptocurrency, gold and silver. And so let's use the example of a private stock investment. So our investor, we'll call him John. John takes $100,000 from his taxable savings account. So this isn't a retirement plan. He takes $100,000 from his taxable savings account and he invests in a, let's call it, risky startup business opportunity. So he purchases $100,000 in shares in this private company, and he waits 3 years without any principal pay down or any returns. And at the 3-year mark, he's fortunate enough, even though it was very high risk, he was fortunate enough to be able to sell the stock. And let's say the company was very successful and he made a $1 million capital gain. Well, under the current law, John would pay 20% plus a 3.8% Medicare surtax. Now, the Medicare surtax came about many years ago, but you would also have to factor that number in, which would bring you to 23.8%. So 23.8 cents on the dollar he would pay on the $1 million gain. That's under the current law. Now, let's look at what that would look like under the proposed law. So under the proposed law, John would have a 39.6% tax on that $1 million gain, plus the 3.8% Medicare surtax, which would bring him to over 43% in tax. And that's not taking into account state tax rates. So if he's in a state that has a higher tax rate, he could potentially pay over 50% in tax. In fact, there's about 13 states out of 50 states and 51 if you include DC that would actually have over a 50% total rate. So the $1 million gain, it's not like under the current law where he would have maybe about $230,000 in taxes paid and he would keep close to $800,000. And under the proposed law, he would only keep about a half of what he made, so about $500,000. Now, that's all in a taxable environment. What if John was to use a Roth IRA? Let's use that as an example. Now, traditional IRAs grow tax deferred and there's benefits there. But a Roth IRA, you'll learn, you put money in after tax, it grows tax-free, and you take the money out, you don't pay any taxes. So let's say John makes an investment in this risky startup business, $100,000 from his Roth IRA. And regardless of whether the law changes or not, it doesn't matter because IRAs are not subject to long-term capital gains tax rates. So in this case, John makes his $100,000 investment, he sells, has over $1 million gain, and that all goes back into his Roth IRA tax-free. So when I talk about hedging against future taxation, whether it's an increase in taxes as a result of policy or an increase in taxes based on your own individual tax basis, an IRA can be a great hedge against those particular factors. So I hope you learned a little bit more about the current proposals that are being made. Again, this is proposed at the time of recording this video, but we want to make sure that investors are well prepared. We talk about leveraging compounding interest in the absence of taxation with self-directed IRAs to help investors increase their yield by eliminating the taxes and by increasing their yield, potentially getting to their retirement goals in a shorter period of time. So I hope you enjoyed this short training. The proposed changes under the American Families Plan does include more than just that. There's also inheritance tax that needs to be addressed, which an IRA could also be a great estate planning tool as well, you'll learn. But we won't get into those details in this short training video. I hope you enjoyed the program. Again, this is John Bowens, broadcasting from the virtual classroom here at Equity Trust Company. Check out our YouTube channel as well for additional training videos and education. Our website is trustetc.com. You can check us out there for more information or education. Reach out to us, and one of our associates can walk you through the process of using a self-directed IRA to invest in real estate, private securities, gold and silver, cryptocurrency, and a wide array of other alternative investments. Here at Equity Trust, we're a directed custodian, which means we don't give you advice or guidance, but what we do is provide education and information so that you can make an informed decision and take control of your financial future. Until the next video training, folks, keep leveraging compounding interest in the absence of taxation.